If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? My name's Obi, and welcome back to Courtside Financial, the podcast where we talk about business and technology. I'm your host, Obi, and today we've got a hot topic that's driving the wheels of the automobile industry. Price wars, annual sales targets, and the challenges car companies are facing as they gear up for the year-end exam. As year-end approaches, car buyers are excitedly anticipating low prices and great deals. The fourth quarter is often a crucial time for automobile sales, with car companies facing what some might call their final exam. To meet their sales targets, they employ various promotional measures like price reductions, freebies, and gifts to attract consumers. But here's the twist. While consumers are thrilled about lower prices, many car companies are struggling to meet their annual sales targets. Recent data suggests that most Chinese car companies are finding the going tough, with only a few expected to hit their annual KPIs, key performance indicators for those of you who don't know. This price war not only affects sales, but also erodes profit margins. New car-making companies like NIO, XPeng, Li Auto have set ambitious growth targets for 2023, with goals well above 60% and in some cases even reaching 88%. For instance, XPeng plans to deliver 450,000 vehicles in 2023, while NIO aims to surpass Lexus 2022 sales figures, and Li Auto strive to obtain 20% of the market share in the SUV market. These goals are challenging to say the least. The completion rates for the KPIs for newer companies like XPeng and NIO are less than 50%, with completion rates of 40.5% and 44.5% respectively. To achieve their annual sales targets, they needed to sell an average of 50,000 vehicles and 40,000 vehicles each month in the fourth quarter. But here's where it gets tricky. According to recent sales data for October, NIO's weekly sales were 4,400 vehicles and XPeng's were 4,700 vehicles. If sales volumes in the fourth quarter continue at this pace, they'll definitely fall short of their annual sales targets. The struggle to meet these targets is not unique to these companies. Other entrants like Leap Motor, Deep Blue, Neza, along with some traditional brands have had completion rates lower than 44%. Competition is fierce, and it's becoming increasingly difficult to hit these annual KPIs. Now let's talk about price cuts. Car companies have been using price reductions as a key strategy to attract buyers, and the pressure to cut the prices is on the rise. This price war has been intensified, with prices falling from high-end to mid-range markets, creating misalignment in the competition. This fierce competition has also spilled over into the sales staff, with dealership employees vying for customers' attention, emphasizing their unique benefits. And while consumers enjoy lower prices, they also worry about buying a car only to see it offered at an even lower price shortly after. So the big question is the strategy of price for volume really a winning strategy? It certainly grabs consumers' attention, but it hasn't been able to revitalize long-term sales for car companies. In fact, it's eroding their gross profit margins. Take Tesla as an example. In the third quarter of this year, Tesla's gross profit margin dropped to 17.9%, down from 25.1% the previous year. The decline in profit margins has been a trend in the industry, affecting both traditional car makers and new entrants. The pressure to cut prices is not only impacting car manufacturers, but also the entire supply chain, including dealers and suppliers. No one seems to be winning in this scenario. It's clear that the last quarter is a critical period for car companies to impact sales, and they're launching limited time promotions to stimulate demand. This price war has intensified, and it's a high-stakes game as companies aim to hit their annual targets. It's a challenging situation, and dealers are also caught in the crossfire. The China Automobile Dealers Association reports an increase in dealer inventory, leading to a passive entry into the price war. Reducing prices seems to be the only way to quickly sell out of inventory in this era where many products are similar. So as we approach the year end, the auto industry is facing a tough battle. Many companies are striving to hit their sales targets with price reductions, but it's unclear who the real winners will be in this high-stakes game. That's a wrap for today's episode of the Courtside Financial Podcast. Join us in the next episode for more intriguing and stimulating discussions such as this one.